Right now, the market is telling two completely different stories, and honestly, they're at war with each other. On one hand, you've got this story of unstoppable growth, a new industrial revolution. And on the other, a sudden, violent shock that has totally redrawn the map of risk. So let's break down this tale of two markets.
So before the shock, the feeling was just euphoria. The market was absolutely electric. And this quote from Dan Ives, it just perfectly captures that feeling. Everybody believed this wasn't just another tech boom. No, this was the dawn of a whole new era, the foundation for the next 50 years of global growth. And you could see this optimism everywhere. I mean, we had 33 record closes in 2025 alone. It felt like every single dip was just a buying opportunity. The only direction was up. And then, in what felt like an instant, the whole narrative just shattered. This is the number that broke everything, $20 billion. It was the largest single liquidation event in market history. A shockwave that just ripped through the market, wiping out traders, wrecking portfolios, and exposing this deep fragility that was hiding just beneath the surface.
Okay, so first, let's unpack the story that honestly almost everyone believed in. We'll call it the unstoppable rally, a thesis built on some incredibly powerful ideas. You had these pillars, right? And they were all feeding into each other. The fourth industrial revolution story was fueling this massive AI spending from big tech. And at the exact same time, the Fed started cutting rates, which is historically a huge green light for the market. I mean, get this. In the last 12 times the Fed started cutting rates near market highs, the market was up an average of 16% a year later. 12 for 12. It really felt like a foolproof formula for success. And here's the rocket fuel for the whole thing. $7 trillion. That's how much cash was sitting on the sidelines in money market funds. So with interest rates starting to fall, the idea was that this massive wall of money was just waiting to flood into the stock market and lift everything higher.
This quote just perfectly sums up the mood. The party was in full swing, the music was loud, and absolutely no one thought it was going to end anytime soon. The market felt invincible. But as we know, every party has a last call. Which brings us to the complete opposite side of the story, the great liquidity shock. This wasn't some slow downturn. It was a sudden, violent reversal that absolutely blindsided everyone.
So what is a liquidity shock, really? Well, think of it like the floodgates opening, and everyone rushing for the exact same tiny exit, all at once. Some sudden trigger dries up all the cash and credit, and that forces anyone with leverage to sell immediately. And here's the key. They're not selling because they want to. They're selling because they have to, no matter the price. Okay, so here's how the dominoes fell, one by one. First, you get the geopolitical trigger, new U.S. measures targeting Chinese tech. That immediately sparked fears about the global supply chain, which then led to a fire sale in the most crowded trade on the planet, high-growth tech stocks. From there, the panic just cascaded into the most liquid 24/7 market out there, crypto. And that's what triggered that massive flash crash.
So why was tech hit the hardest? Well, because its valuations were priced for absolute perfection. And when you're priced for perfection, any tiny crack, any question about that story can bring the whole thing crashing down. The market's darlings basically became its biggest liabilities overnight.
But here's where it gets really interesting. The crash didn't just destroy value. It actually revealed something new about the market. This is our synthesis, the emergence of a truly divided market, and with it, a whole new map of risk. See, underneath all the scary headlines about tech getting crushed, a completely different story was playing out. Not everything was crashing. In fact, some assets were actually doing really well, signaling this massive rotation of capital into some pretty unexpected places. This chart tells the whole story. As money was fleeing big tech, it found a safe place to land in two very different areas. First, the classic safe havens, gold and silver. But also, and this is the really surprising part, in the Russell 2000, an index of smaller, more domestic-focused companies. So what on earth does that tell us? It tells us that the market was suddenly trying to protect itself from two completely different threats at the exact same time. The move into gold and silver, that's a classic flight to safety, right? A hedge against geopolitical chaos. But the move into the Russell 2000, that was a hedge against the bull market itself, a rotation away from that super concentrated, globally exposed big tech trade and into domestic value. Now, crypto's journey through all this was a total roller coaster. First, it crashed hard right along with everything else, which confirmed just how sensitive it is to these big liquidity shocks. But then something powerful happened. A huge wave of institutional demand from the new spot ETFs came in and bought the dip with massive inflows. This created a really strong price floor and a super fast rebound, which showed everyone that crypto could actually be a resilient place for capital to go. But wait, there's more. While all this chaos was unfolding in the markets, another, almost tectonic shift was happening behind the scenes. One that would fundamentally change the digital asset landscape and involved the world's largest economy taking on a brand new role. 325,000. That's the number of Bitcoin now held by the US government after its single largest crypto seizure in history. Just like that, overnight, the United States government became one of the biggest Bitcoin whales on the entire planet, a move that is going to have repercussions for years. And this move, as you can imagine, created two totally opposite but equally powerful stories. The bull case is, wow, this is the ultimate validation. The US is basically treating Bitcoin like digital gold. It creates a massive supply shock by taking coins off the market, and it could kick off a global race for other nations to build their own reserves. The bear case? It's a huge centralization risk. A single government now controls 1.5% of the total supply, a potential $36 billion weapon hanging over the market that could be used to manipulate things if policy ever changes. So where do we go from here? How do we even begin to navigate this new, much more complicated map? The key question is, what are the signals we should be watching that will guide us through this new reality? This table pretty much lays out the key signals to watch. On monetary policy, any hint from the Fed that they're getting more dovish could be pure rocket fuel for a tech rebound. Geopolitically, the US-China relationship is now front and center for the market. For earnings, all eyes are on big tech and the chip companies to see if that massive AI spending story still holds up. And in crypto, those daily ETF flows are going to tell us if this wave of institutional adoption is the real deal. So the big takeaway here is this. The market has fundamentally changed. We've gone from a simple, one-dimensional story to a really complex, multifaceted tug-of-war between all these powerful competing forces. And that leaves us with this one final crucial question. For the first time in a long time, the market is simultaneously pricing in a global trade shock, a tech valuation reset, and long-term currency debasement. All these threats are now live. The real question isn't just which one matters most, but can the market even handle a world where all of them matter at once?